Wells, Bank of America, Citi, all out beating on the bottom line. On the top line, the picture gets a little bit more nuanced, and then underneath the surface, we can really see what's going on in the financial sector. Yahoo Finance's Brian Cheung stopping by to give us the look at these firms. So, Brian, I'll let you take them, I guess, in sequential order from when they came out this morning, which would be B of A, Wells, and Citi, and then the rundown that you're seeing here in these results.
Yeah, absolutely. So the second day of the second quarter of earnings kicking off. So let's get started down in Charlotte, North Carolina with Bank of America. As you mentioned, they had earnings before the bell this morning, beating on the top and bottom line, or rather missing on the top line, beating on the bottom line. Their net interest income fell 6% due to lower interest rates. And the CFO, Paul D'Onofrio, was telling reporters earlier this morning, loan growth looks like it's starting to tick up. And he said there's hopefully more to come in the coming quarters, but miss on their investment banking revenue was a big reason why they could not beat on the top line. But let's hop on a flight, head out to San Francisco, California. That's where Wells Fargo is, although their CEO is probably sitting in New York. That's Charlie Scharf. That's where he's based out of. But they actually had a different story. They beat on the top and bottom lines pretty handily, as you can see on the numbers ahead of you. They had a 37% year-over-year increase in non-interest income, specifically in their venture capital and their private equity businesses, so not their bread and butter consumer businesses. In fact, their corporate business brought in $3 billion in revenue for the quarter, so pretty impressive results from Wells Fargo, despite the fact that they still face that asset cap from the Federal Reserve. But let's head back east, downtown to New York City. Let's take a look at Citigroup. They did beat on the top and bottom lines, beat pretty handily on the bottom line. They were pretty close to estimates on the top line, and that's a lot because of their revenues decreasing 12% from the same quarter last year. They managed to eke it out on the bottom line because of a number of things, like the lower cost of credit, so the expenses were down, and then in addition, they were able to reduce their share count, which obviously helps the earnings per share on the bottom line. But let's now take the train up to Midtown, still staying in New York City. We go to BlackRock. I did want to highlight that. Not quite a bank itself, huge financial services firm, so definitely worth highlighting still. They beat on the top and bottom. They actually beat on the bottom on an adjusted basis, but I believe they missed on a GAAP basis. We can get into that later. But their ETFs business continued to fire on all cylinders. They had $75.2 billion in net flows for the quarter. That made up for about $1.5 billion in revenue. Now, keep in mind, their ETFs business makes up about 40% of BlackRock's business, so pretty important there. But guys, broadly, the thematic elements that we've seen from the big banks from yesterday, JP Morgan Chase, Goldman Sachs, and the banks that we've heard from today, net interest margin weakness. That's been a theme that's been happening through the crisis with a flatter yield curve. It's hard to make more money off of the interest earning assets. And then it's not really helping when you're paying out just a few basis points on their deposits as well. We saw the net interest margin, a key metric, fall among all the major banks. But because of that, investment banking strength was a way that they could account for any sort of decline in their net interest income. That's a big reason why Goldman Sachs knocked it out of the park yesterday. But Bank of America saw their corporate investment banking fees decrease by 2%. That's a big reason why they missed on the top line, as I mentioned earlier. And then reserve releases. Again, as the economy gets better, these banks hopefully not provisioning as much because credit quality turned out to be better through this crisis than they thought. Big reason why Bank of America had a reserve release of $2.2 billion. We've seen similar stories at other banks as well. So yes, across the board, a bit of a mixed bag, but broadly speaking, these banks are still standing up quite well, especially given the shock that we've seen. And they seem pretty optimistic as the economy continues to rebound through those vaccination processes as the economy continues to reopen, guys.
Yeah, Brian, I thought the uniform release of reserves and the way that it impacted bottom line results is pretty much as textbook as it gets for a reminder that earnings are made up and can be sort of whatever companies want them to be, right? This is a pure accounting transaction that gets that bottom line, result looking good. And I think this quarter, it couldn't have been a clearer example. You look at deposit levels at all of the major money center banks, up 15, 20%. The business of banking is moving the money around, and simply accumulating the assets, which is really what seems to have happened here, is just not enough to get that top line moving.
Yeah, and I think that when it comes to the financial engineering, you would have to really, really miss the mark to miss on the bottom line. Because as you mentioned, these banks have so many levers when it comes to specifically their stock float to be able to beat on the bottom line. That's why when you take a look at specifically Citi's numbers, their big story this year, or rather for this quarter, was in the absence of loan growth, which, by the way, is an industry-wide story. you have to do other things in order to beat on the bottom line. In their case, it was cutting expenses, making sure that because of the low rates that they could take advantage of lower credit costs, and then also taking advantage of the share buybacks, which they got a green light from after the Federal Reserve's last round of stress tests. Now, whether or not that continues to be a story, I think depends a lot on loan growth itself. Keep in mind, banks, yes, people think the bread and butter of you lend out money, you make money on the interest that people pay on those loans, and then you pay out whatever the difference is on deposits that are being held at the bank. Then you hope that that spread, which is the net interest margin, is going to keep you afloat. Well, what happens when the curve completely flattens, as it did in the crisis, and when the yields aren't going back up even through the recovery? You have to rely on other sources of income. That's why investment banking has become a big part of the last this quarter and the last quarter. It was actually trading revenue in the depths of the pandemic, but we have less volatility in the markets now, which is a big reason why even trading revenue can't save you. So it's all about these banks having diversified revenue streams and being able to rely on, you want to call it countercyclical, you want to call it hedging, other types of business lines to keep them afloat through these different types of, I guess, periods, acts, if you will, of the economic cycle.
Yeah, and I think, speaking of those other business lines, I'm not sure too many people had on their bingo card Wells Fargo realizes gain from venture activities,
Yeah.
but such is life. Let's talk a little bit more about BlackRock's results, and specifically, what we've seen from them outside of just the quarter. But Larry Fink's comments this morning on inflation on CNBC certainly making some headlines, and I think always interesting because of Fink's breadth within the Fortune 500. Always interesting to get his comments, and then also headline just crossed the tape before we came live: BlackRock raising pay by 8% for everyone who is director level and below, which maybe that informs Fink's inflation view a little bit, but it certainly shows another undercurrent of these bank results, which is competition for workers. And almost every bank CEO talked about that on the call, and it started as this Goldman slide deck meme sort of thing, but now it's a real part of the cost side of the equation for these firms that I don't think can rest on their reputation the way maybe they did 20 years ago.
Yeah, and well, the anecdote that you shared about BlackRock raising pay by 8% for a large percentage of their workforce is pretty emblematic of the labor dynamics that we've been seeing just across the board, not even in the financial services industry, right? A difficulty to find bodies to staff up jobs that they desperately need to fill. But of course, when it comes to wage growth, yeah, it's fantastic, I guess, that we're seeing wage growth in the financial services industry. But when you're talking about people that are making $200,000, $300,000 a year, I'm not sure that too many people are saying, wow, this is just great for the macro economy at large. Obviously, wage growth is something you like to see in other types of industries, especially those that were more hard hit than the financial services industry in the depths of the pandemic. But it does speak largely to the idea of the cost-cutting concerns that you have at these banks. Because on one hand, yes, these banks are doing very well. Let's not get it twisted. They stood up incredibly well through the pandemic. They were able to continue to be profit-making machines through all of these quarters. But when you do have labor costs increasing, can the banks continue to make those margins in coming quarters when you have this kind of shell game happening every single quarter? If it's not trading revenue, you're relying on investment banking and IPO underwriting. And if it's not that, then you're hopefully just keeping your fingers crossed that loan growth can come back. But at the end of the day, if it really does come down to cutting expenses, how do you do that when you're having to pay more just to find laborers to staff up the bank? That's a big reason why automation is becoming a big story for the banking industry over the next 10 years. You have the likes of Mike Mayo saying that hundreds of thousands of jobs could be disappearing because of banks trying to automate some of these positions. So I think when we talk about just the changing nature of this industry, I think that it speaks to a more structural trend, not just something that's happening in these quarters as a result of the economic recovery.